So you moved for work in California. Well, you're going to want to listen up. There's a really valuable state tax deduction you need to know about, one that's actually gone from your federal return. We're going to do a deep dive and break down exactly how it works using California's Form FTB 3913, step by step. Right, so if you moved for a new job anywhere in the Golden State, this is for you. You see, while the big Federal Tax Cuts and Jobs Act pretty much suspended the moving expense deduction for most people, California said, no thanks. They decided not to conform. And that means a deduction that has totally vanished on your federal 1040 is potentially alive and well on your state return. Okay, so here's our game plan. First, we'll talk about why this deduction is so unique to California. Then we'll get into the two key tests you have to pass to even qualify. After that, we'll break down what costs you can actually claim. We'll also touch on some special rules for military folks and others. And finally, we'll walk you right through how to calculate it and put it on your tax return. So what's the deal here? Why is California the odd one out? Well, the reason is actually pretty simple. California's tax law is based on the Federal Internal Revenue Code, the IRC. But, and this is the key, as it existed way back on January 1st, 2015. It's like they put the old federal rule in a time capsule. So even though the rule changed for the rest of the country, it's frozen in time for California taxpayers. And what that means for you is this. California continues to offer this deduction for anyone who relocates because of a new main workplace. The specific form you'll need to figure this all out is California Form FTB 3913. So let's get into who can actually use it. To claim this deduction, you have to jump through two key hoops. They're called the distance test and the time test. For most of us, non-military members, you absolutely must meet both to qualify. So let's break them down one by one. First up, we've got the distance test. The whole idea here is to make sure your move was for a pretty significant change in your commute, not just you moving across town. So the rule is this. Your new job has to be at least 50 miles farther from your old house than your old job was. And hey, if you didn't have an old job, it's even simpler. Your new gig just needs to be at least 50 miles from your old home. So how do you actually figure this out? It's super simple, really. You just take the distance in miles from your old house to your new job. Then you subtract the distance of your old commute. That's from your old house to your old job. If the number you get is 50 or more, you've passed the distance test. If it's 49 or less, sorry, you can't claim the deduction. All right, on to the second hurdle, the time test. This one is all about making sure the move was for a real sustained job. If you're an employee, you need to work full-time for at least 39 weeks in that first year after you move. Now, if you're self-employed, the bar is a little higher. You've got to work full-time for at least 78 weeks during the first 2 years. But, life happens. So, of course, there are exceptions. You don't have to meet that time test if your job ends for reasons that are pretty much out of your control, like a disability, your boss transfers you, or you get laid off, as long as it wasn't for willful misconduct. And, like we'll talk about in a minute, members of the armed forces and some retirees are totally exempt from this test. Okay, you made it. You passed both tests. Now for the really important part. What expenses can you actually deduct? The rules are really specific here, so it's absolutely crucial to know what's in and what's out before you start adding things up. And this table just lays it all out perfectly. On the deductible side, you've got the core costs, moving your stuff, packing, insurance. You can even include up to 30 days of storage. And travel and lodging for you and your family on the way to your new home are covered. But now, look at that other column. Meals are explicitly out. Same with costs for buying or selling a home, breaking a lease, or getting a new driver's license. Now, if you drove your own car for the move, you can deduct that cost. You've got two choices. You can either track your actual expenses, like gas and oil, or you can take the much simpler standard mileage rate. Just for 2022, that rate actually changed mid-year. It was 18 cents per mile for the first half, and then it jumped up to 22 cents for the second half. Now, the rules we've been talking about apply to most people, but we need to talk about a few groups that have slightly different rules. The state totally gets that from members of the armed forces or retirees moving back to the U.S., the standard rules don't always work. For members of the armed forces on active duty, things are way simpler. If you move because of a permanent change of station, a PCS, you do not have to worry about the distance or time tests at all. Basically, your military order is all you need to qualify the move. It's also really important to remember that any moving services or money the government gives you don't count as income, which also means you can't turn around and deduct those same costs as an expense. And here's a really interesting one for retirees. If you are working abroad and you're now permanently retiring and moving back to the US, you can deduct those moving expenses. The catch is that both your old home and your old job had to be outside the country. You do still have to meet the distance test, but you get a complete pass on the time test.
All right, let's roll up our sleeves and get practical. We're going to walk through the calculation on the form itself, FTB 3913. And don't worry, it's actually really straightforward, with just a few key lines you need to fill out.
The very first number you're going to need is for line 1. This is where you put the total cost of physically getting all your stuff from point A to point D. This includes what you paid the movers, the cost of all those boxes and packing tape, and like we said, up to 30 days of storage if you needed it. Next up, on line 2, you're going to add your travel expenses. This is just for that one-way trip for you and your family to get to your new home. You can include things like hotels for lodging and your car expenses, either the actual costs or that standard mileage rate. But here's that crucial reminder again. You cannot deduct meals. Okay, this next step is super critical, so listen close. On line 4, you have to report any and all moving expense money you got back from your employer. If your company gave you a moving allowance or paid the movers directly, that amount has to go right here. This is to make sure you're only deducting what you actually paid out of your own pocket. And all of that brings us to the grand finale on line 5, your final deduction. You just take your total expenses, subtract any money you got back from your employer, and whatever is left is the amount you can deduct. It's as simple as that. So you filled out Form FTB 3913, you've got your final number. Now what? Well, the last step is to get that information into the right spot on your California tax return, which for most people is going to be Schedule CA 540. There are 2 ways this can play out. First, what if your employer was extra generous and their reimbursement was actually more than what you spent? Well, California sees that extra cash as taxable income. You'll have to report it as an addition to your income on Schedule CA Part I, Section A on line 1H in column C. Now, for the scenario most of us are going to be in, your expenses were more than what you got back. That difference, the number from line 5 of your FTB 3913, that's your net deduction. You'll report that amount as an adjustment to your income on Schedule CA Part I, line 14 in column C. And that's how this whole thing actually lowers your California taxable income. And there you have it, the California Moving Expense Deduction. It's a perfect example of why you can never assume that state tax laws are the same as federal ones. It really makes you think, doesn't it? What other little differences between state and federal tax codes could be out there, quietly impacting your bottom line?